Welcome to our webinar today on the logistics of retirement. This is Jim Bell, President and Founder of Bell Investment Advisors. I'm here with Bonnie Bell, Principal and Director of Career and Life Coaching. This webinar was motivated by our clients over the past 20 years telling us that they were frightened by the prospect of giving up their income from work and giving up the satisfaction and structure of their careers. As we go through the slides today in the conversation, please submit questions in the question box on your screen, and we will answer them at the end of our presentation. If we don't have time for your question, we will get back to you with a phone call or email to make sure you're satisfied. If you are having technical difficulties, you can also submit those as a question or call our office at 1-800-700-0089. Okay, Bonnie, why don't you start us off by talking about transitions?
Yeah, in my career coaching for many years, I'm always helping people transition. So it's difficult moving from one stage to another. It's always difficult if you think back to your own life. These are times when negative voices come up, you're full of fears, even when you want to make a change. So many people can't wait to retire, but they're kind of forgetting that there are adjustments to be made, and transitions always are difficult. So traditions are always difficult because they produce anxiety. It's not knowing. It's as long as you have a name of your job, a place where you work, that kind of anxiety is at bay. But when the prospect even comes up, it's going to produce anxiety. And every change implies a loss, even when it's a positive change. You might think about marriage. You know, it's like you want to do it, you're all excited about it, and there's going to be, you're losing something. Same thing with retirement. And then you have to, or a situation will force you to kind of begin to face the reality, feel a little bit of pain, insecurity, and then it's going to require that you plan and then continue learning before you reach the place where you've reoriented, you've accepted it, and then you've worked it out, so that many people do experience joy. But it's not automatic. You really need to do some work and pay attention. So one of the things that we talk about in the company with all of our offers is the good life. So making a good life happen is a theme. So we're going to move to Jim. Jim's going to talk a little bit just about the asset distribution, and I'll come back.
Okay, great. Thanks, Bonnie. We're going to be talking about planning as we go through the presentation and the slides today. The logistics of retirement work best when you have a retirement plan. We've certainly observed that for over 20 years now. At Bell, we offer a retirement outlook plan for only $1,000. It's a great bargain, and we observe that clients who have a plan are happier than those who don't. It really allows us to strengthen our relationship, our planning, and the success of reaching your goals. We also have a package that we call Making a Good Life Happen, which integrates career and life coaching with financial planning. So we often say here at Bell that we're about not just the quantity or financial aspect of your life, but also the quality of your life. And this package, Making a Good Life Happen, integrates quality and quantity in a very effective way. So let's get into some details. One of the fears is about how is income going to work when you're no longer earning income from work. So a place to start is that there's usually two types of accounts that you have or our clients have. The one type are tax qualified accounts for tax deferral. These are funded with pre-tax dollars. Usually you got a tax deduction to fund those plans into your IRA or your 401ks. The second type of account are non-qualified, non-tax qualified, meaning they're not eligible for tax deferral. these are usually funded with after-tax dollars. This would be an individual or joint brokerage account or trust accounts. And one of the ways that we work with people in planning is how should the income begin when you first retire and need supplemental income. So from our point of view, we start from the prospect that it's often the case that drawing from the taxable accounts, the non-qualified, non-retirement accounts, often is the best place to begin because the principal in those accounts has already been taxed and you can withdraw money that may or may not be taxable. Taxes are generated only by realized gains, dividends, and interest. You might have a year without realized gains or with realized gains and losses that cancel each other. A gain or loss is realized only when you sell shares. So the taxable accounts are often the most efficient way to begin drawing income. So Bonnie, let's talk about what is a good life.
So it might seem strange to shift from those financial logistics in your thinking to thinking these other questions, but that's a point that we want to make, that you need to integrate thinking about your retirement in terms of money, but also thinking about the content of your requirement, of your retirement, which means what's the content of it. So the best way to answer it is not to brainstorm and not to really assume anything, but shift to the questions of what a good life is for you. Many of you already have been thinking with this question, but it's the basic philosophical question, and no one can tell you what that is. So these are questions that can help you begin to get connected with what you want to do in retirement. So the easiest one, and it's actually a very deep question, seems like nothing, but to really get in touch with what you love to do. So these are the activities you love, not just the people you love, but the things where you really lose track of time and you're enlivened and it takes you to an exciting place. Another very important thing that continues throughout life is your values. The more connected you are to your values, the more satisfied you're going to feel. So that question is, what do you care about most? And that can be many things. You can have a conversation with your spouse and talk about your individual's values and how you can merge them. If there's not a partner, so be it. Then it's up to you. Another one is about your dreams, all the times that you were working and you thought if only I had more time, I could do whatever it is. So whatever those things are, you now will have time to do them, but not necessarily unless you make a plan to actually act on what those dreams are. And then also to not stop thinking about goals just because you're retired, because you can have goals within retirement that can be very satisfying. The questions of momentum are also integrated throughout all of our offers. It's our basic investment strategy. But the questions that underlie that apply to the rest of your life. And they're very simple questions that you don't have to dig too deeply. One is what's working. So pretty much all of you can pretty readily think about what's not working in your life. Well, this applies to retirement. So once you're in retirement or you're facing it, you want to look at what's working, what's not working, what's missing, and what's next. These are questions to integrate. It's a great thing to do every year, at New Year or on your birthday, and it's a way to stay on top of what's working or not working. You want to build positive momentum for a good life and for a good life in retirement.
So we're going to transition now from the quality of life conversation back to the quantity of life conversation and talk about what is your strategy, what is our strategy for producing sufficient income during retirement. And one of the issues that we have right now is that yields, as I'm sure you all know, are extremely low in money market funds and bond funds. So for the 20-plus years that we've been in business, we've always believed that long-term sufficient income must be generated by a growth and income strategy. So I often think of it or refer to it as, in the old days, the strategy and the thinking was that as you approached retirement, and certainly once you retired, your whole financial assets, all of your portfolios would be in fixed income, some kind of bond fixed income strategy, 100%. Well, that may have worked in the old days when most American workers, the average American worker died at age 64, but it's not working today. We're all living much longer. Almost everyone who's my age at 65 has a relative who's well into their 90s. This is becoming more and more common. So the longevity of that challenge is extremely important to analyze and plan for. So one of the things that we're talking about here is what we think of as a myth that retirement strategies succeed because you increase bond allocation. That's not a foregone conclusion, or certainly something that is set in stone. As you can see here from the study, what we've done on this table is look at rolling 20-year periods from 1926 to 2010, long history that we've studied here. And you can see from the corporate bond market to U.S. Treasury bills that there have been many 20-year periods where negative real returns were produced by these different bond markets and indices. So a retirement plan is not going to be successful generally if you have negative real returns for 20-year rolling periods from anywhere from over half the time to 20, 24, 25% of the time. You'll notice at the bottom of the table here that large cap and small cap stocks for this period that we're studying have never had a 20-year period of rolling returns where they did not produce real return. So that's why we believe it's so important to integrate growth stock strategies with fixed income and bond strategies in retirement. This next chart's going to report that currently our inflation rate is at 3.8% year over year, ending in August of this year. And from this list on the table of where the bond market is in terms of treasuries, munis, and corporates, you'll see all of them fall way short of even reaching the percentage of inflation at the current period. So this is just another reason why we think growth and income strategy for producing sufficient income is vitally important. This next chart shows the rewards of investing. It covers 34 years. The chart starts with a balance of $10,000. And you can see on the blue bar there that the Consumer Price Index has taken $10,000 and it's now over $40,000. So for these 34 years, you needed to have investments that were going to grow $10,000 to at least almost $41,000 just to keep pace with inflation. So inflation is the great motivator for why we need growth investments, because it's always a threat. The yellow line tracks the U.S. Treasury bill bond index, and the red line is the Barclays aggregate bond index that now includes some corporates along with treasuries. The green line produces the best results. 10,000 has grown to almost 430,000 at the end of 2010. It also produces the most anxiety, because you can see from those two drops starting in 2000 with the technology burst, and in late 2007, 2008 with the Great Recession. Those are breathtaking drops. So one of the reasons why we think planning is so important is that the process that we implement here is that we have a required return calculation for each of our clients on a customized basis that will determine the optimal ideal portfolio for how much of the green bar do you need, the growth investments, and how much of the bond allocation do you need. And again, I want to emphasize that we do planning on a standalone basis, or we can combine it with career and life coaching or investment management, but it's not required that you do this. Next, I want to talk about what we call the 6-month income cycle. This is also important to our clients to understand how we work in terms of getting your supplemental or your income out to you. So what we're talking about here is that when we have clients who are going to begin a regular distribution schedule to receive income, let's say, for example, we're going to send a client $5,000 a month. At the beginning of that process, we are going to set aside 6 months or $30,000 so we have money readily available to make those monthly distributions. As we pay that down over 6 months, we're going to replenish that 6-month pool by analyzing the portfolio or portfolios and finding the most strategic place to set aside another $30,000 or 6 months of income. We found this process to be very beneficial because it's a structural way to analyze the portfolio and look for the most strategic place, whether it's taking into account tax consequence or just selling the weakest positions that we own. As most of you know, I'm sure we custody all of our assets and accounts with Charles Schwab and Company. They have excellent features like a money link process where you could fill out some paperwork that we will make available to you, and your income can go directly to your checking account. We don't have to mail you a hard check. You know exactly when it hits your account, and it's a pretty fail-safe process. So next we're going to talk about required minimum distributions. This is something that a lot of people fail to understand. This relates to retirement accounts, so we're talking about the tax-qualified accounts, the IRAs, the 401ks. You can see at the top there that this table from the U.S. Treasury publication 590, who it applies to. They have other tables for special situations. But the way this works is that when you own an IRA or a 401k or some kind of other retirement account, at age 70 and a half, the U.S. Treasury wants you to start taking distributions. Why do they want you to start taking distributions? Because they want you to pay tax on it. This is money that you got a tax deduction for funding, and they would love to tax you before you die. So that's putting it in very plain terms. So when you reach 70 and a half that year, you are required to take out a distribution, and the factor number here is 27.4 at age 70, so that equates to a 3.65% distribution the first year that you're required to take a distribution. I should say that you can defer that first year distribution until your 71st year, but then you have to take out 2 years in the same year, and that may change your tax bracket. So this is one of the things that we do in our planning process, is to find the ideal way to make sure that we don't force you into a higher tax bracket where you're going to be paying more taxes on your retirement distributions than you would have had to with some careful planning. Next question is about cash reserves. How much people ask us this all the time. In our webinar that we did last month that's now on our website was all about cash reserves. So what we found is for clients who are no longer earning income from work, it's pretty ideal to have 2 years of living expenses set aside. And if you listen to our webinar, if you're going to go back and listen to it, you'll know that we make a distinction between excess reserves and immediate or emergency reserves. Well, with the excess reserves, we've been able to earn 5.4%, which we reported in our webinar last month, for these past years of 2010 and so far in 2011. That's been our average return on cash reserves. The minimum amount is certainly 6 months, which we've already talked about in terms of our income cycle. So this will be our last slide about the quantity of life, and this is part of our planning process as well, where we have a stress test for your plan. This is a real client of ours. We've removed any identity to protect her, but she's a single woman at age 66. She's just retired. She has a balance of $924,000. We've done detailed planning with her, so we know exactly how much she needs to supplement her income to have a successful life and plan. And the way this stress test works is that we take into account her investment strategy, but also her withdrawal rate. And we're assuming that she's going to live to be age 100. So we've really built in a lot of conservative safeguards. And given her rate of withdrawal and the strategy in her portfolio, this plan has a 94% success rate. So we think it's important for everybody in a retirement process to have this kind of analysis and assurance from a probability analysis, and we love doing this for clients. So Bonnie, let's go back to some quality questions.
Yeah, so again, there are many people. We get to witness wonderful things that happen to people in retirement, and we also are aware of many retirements that aren't working out that well. So we want to keep those questions alive during retirement, and that's what's very exciting about keeping this alive. Many people do a financial plan and they put it on the shelf, and that's not where it belongs. It needs to remain alive. Same thing with retirement. So we want to keep it alive and keep those momentum questions active, because that's the good news. Whatever isn't working points to what would work. What is working, you want to do more of. You want to pay attention to what's missing and what's next, just like you do with your careers and the rest of life. One of the things that's a common thing that I hear is, and research also supports this, that people that don't plan for the content of their retirement, many within 2 years end up feeling bored, or they feel like they've withdrawn from the marketplace. They don't know what's happening again. Or people complain that their kids live in different locations around the country. They miss their grandchildren. So there's always room to implement a plan or to tweak the plan so it remains alive. So there's some examples that came quickly to mind just in people that I've worked with. And by the way, retirement coaching is a pretty new term, but that's included in the life coaching that I do. So it's a big transition. People used to think they were going to just retire and put their feet up, and that's not really what people in the knowledge age feel like doing. You have lots of education, lots of skills. You want to keep contributing so that you feel alive, you feel connected. So one of the clients that comes to mind is a woman who actually has a pretty limited retirement. She doesn't have a whole lot of money to work with. She's going to be okay, but she has found ways to earn money during retirement, and I think this is a great idea. So I helped her turn some of her hobbies into money-making activities. So she is a PR person all of her life, and she was always a talented writer who fantasized about being an actress. So she's doing all that now, and Jim and I got to go see her in the one-woman play that she wrote and acted in San Francisco. And she also has become, she's quite a well-known storyteller now, and she used to do it as a hobby, and now she gets paid to consult with school districts, and she travels around the country. So it's kind of an example. Think of things that you love to do that you could actually get paid for if you want to add to your retirement income. Another client is someone with a big heart for kids. He's always donated money to children's charities, but in his retirement, he spends a lot of time actually working volunteer with the Make-A-Wish Foundation. So he's the guy that will take these kids, often who have a terminal illness or some other illness, and makes the dream come true. So he might go to Disneyland or he might go shopping. Another thing that a lot of research shows people are doing, especially baby boomers, like there was a story a few years ago in the Wall Street Journal, where have the baby boomers gone? And the answer was back to school. So this is a very common thing people do, get a graduate degree or complete a bachelor's degree, study a subject that they always wanted to but couldn't. One of our clients had always dreamed about studying archaeology, so he went to Cal not as a full-time student, but he did really enjoy pursuing that and is still doing it. And then writing a book. I mean, when you're in your retirement years, you have lots of power, you have lots of knowledge, you have lots of skills, and many people can contribute in that way. And one of the women that comes to mind is someone who's a social worker all of her life. And she wrote an incredible book that was just published last year, and it's a thrill because she's been wanting to write a book and wasn't able to. So how are our questions coming along?
Very well. Thanks, Bonnie. That concludes the formal part of our presentation. We have one question that's come in that I'll just answer real quick. I'll just read it here. It's do the inflation figures of 3.8% year over year include U.S. dollar devaluations? So obviously this questioner is concerned about the loss in value of the U.S. dollar compared to global currencies. I would answer it by saying that the inflation figures in the United States include it as an indirect effect. So whatever effect the weak dollar has had on our inflation rate, it would be reflected within our national boundaries with the inflation rate. So we have another question that's come in, but I want to review a couple things with you. First of all, thank you for joining us today. Our next investment committee update, the webinar, will be next month on November 16th. That'll be from 2 to 2:30 Pacific Coast time. These investment committee updates that we do quarterly are always for just clients only. You can see on the slide here that our cash reserve webinar in a no yield environment that we did in September, that's now recorded and available on our website, and you can see our library there. If you do have questions, go ahead and submit them. We still have a minute or two left. You don't have to wait for webinars to be in touch with us. You can always call us at these numbers on the screen or email into us. We'll get back to you promptly. We have time for one more question. This question is saying that most investment management firms or wealth management firms don't charge separately for financial planning. It's part of the package that comes with the investment management fees. So why does Bell Investment Advisors charge for it? Well, let me go ahead and answer that. I've been in this profession now for 29 years, and I've done it both ways, charged for it and not charged for it. And with all my experience, I've come to the place where it's important. People are more engaged when they are paying for something, as some people might say they have some skin in the game. So we've just found it's a deeper engagement. There's more involvement, and we can do a lot more with it. So it's a conservative position, but it certainly has been an important decision to implement that here, and we feel the way we priced it with our menu and the targeting of the financial planning process, that it's a real bargain. And our clients who have gone through it would echo that. I'm quite confident. So that's brings us to the 30-minute mark. Thank you again for joining us. We hope that you'll continue to stay in touch, reach out. We're always happy to hear from you. There's a number of ways to follow us on Twitter and LinkedIn, and Bonnie's Career and Life Coaching blog has had a great response. So keep up with that. And today's presentation slides are available. If you let us know, we can email those out to you. So please reach out to us about that as well. Thank you very much for your time.